Cody, thank you so much for joining us. And how are you today?
Ash, I'm doing great, man. I want to thank you so much for having me on. I've been a big fan of the Best Ever podcast for many years now. So it's just an honor to be here, not only as a fan, but as a guest.
Well, Cody, the pleasure is ours. And before we get started, can you give the Best Ever listeners a little bit more about your background and what you're focused on now?
Absolutely. Again, as you mentioned, I'm a managing partner at our company, Blue Oak Capital. I'm also the director of acquisitions for our team. And we focus on core plus assets across Central Texas, Houston, San Antonio primarily. I've been a real estate investor since 2010, spent many years in the single family residential space, pursuing multiple different strategies in residential real estate, but realized after many years and after a lot of expensive lessons along the way that this is just really, it was a hard model to scale. And for me, real estate was a path to financial independence and financial freedom and entrepreneurship. So after many years of going through a lot of headaches, decided to make a pivot and pursue multifamily syndication as a faster scalability to reach my investment goals and thesis. And so here we are, met two great partners. We formed Blue Oak Capital late 2019, early 2020, and we've been off to the races since.
Before multifamily, was it just single families?
Yeah, single family. And I actually pursued some non-real estate related business ventures, but that's another topic for another day.
That's a whole different podcast subject, huh? The two partners, how did they come into the mix?
Networking. I was working with a different partnership group on another opportunity. Late 2019, was introduced to my first partner, John, through a mutual connection. And we just really had a great synergy, great alignment of interests. We started finding opportunities to work together and really saw a long-term partnership developing. So we decided to formalize our partnership through that opportunity. And then midway through 2020, John met our third partner, Brian, through a virtual networking event and connected with him offline, started building a little bit of rapport, introduced him to myself as well. And again, just great synergy, great alignment of interest, great complementary skill sets to our partnership, and the stars aligned and we added Brian to our team, and just one more pivotal piece to the puzzle, so to speak.
Is one of your goals to do real estate full-time?
Absolutely. This is definitely the long-term vision for us. And this is where we see our path to securing that financial independence that we're all trying to achieve.
And your role is director of acquisitions. How do you find multifamily units?
That's a great question. It's really challenging right now in this market cycle, right? But all of our deal flow comes through broker relations. Brokers are your gatekeepers to the commercial real estate world, especially in the size properties that we're looking at, the 100 plus unit apartment buildings. So all of our deal flow comes through broker relations, and just nurturing those and trying to be involved in looking at any opportunity that comes across that fits our investing thesis.
And what is your investment thesis?
So again, that core plus really for us right now is our primary strategy, given where we're at in this market cycle and the execution risk that comes along with the value add play, especially when you're paying a premium like we are right now in today's market cycle. We really like the newer stabilized product, something that can be a long-term hold with less deferred maintenance, less CapEx needed to properly operate. So we've made that pivot kind of halfway through last year and have made that our core thesis moving forward.
And Cody, you've mentioned market cycle a few times. Give me your thoughts on that.
Oh man, it's an interesting one for sure. We entered multifamily in 2019, very, very bullish cycle. I think a lot of people at that time thought we were maybe at the top of that expansion cycle. And then with COVID hitting, again, everybody thought, okay, here's the correction. And then what did we see after, right? The market just exploded even more and just even more aggressive. And so I definitely think that we are still in an expansion part of the cycle. As a United States, if you look at the supply and demand imbalance, we're in a significant supply shortage for multifamily housing, residential housing. So there's still a lot of tailwinds for supply and development. So I think we still have a bright runway here for the next couple of years as far as commercial real estate goes.
And that's why you guys are buying mostly newer properties?
Yeah, again, I think obviously everybody knows right now that we're entering in a rising interest rate environment. How that will impact multifamily, I guess it'll be dependent on how aggressive the Fed will raise their rates this year. But I think with that, if the market does slow down any at all or even pull back some over the next couple of years, again, we want to be in a position to hold assets longer term. 5, 7, even 10 years. And when you're holding that 60, 70 product that's constantly has deferred maintenance issues or constantly worried about what problems are going to need to be fixed tomorrow, it kind of rustles your feathers a little bit. So we like to be able to sleep better at night knowing that we have a quality product that doesn't have all those deferred maintenance headaches that come along with it.
And does your business model have value add, or do you buy fully renovated properties?
We're typically finding properties, like I said, that are in great shape, a newer product. We are looking for a light value add component. And if you think about the market and how fast expectations are changing, how fast standards are changing, we're looking for product that's, call it, 2000, 2015, that could use a light cosmetic upgrade, right? Maybe changing the color scheme, color palette, adding a few modern technologies like prop tech, things like that are becoming an expectation for today's renters and demographic. So we are looking for a light value add component, but we don't want to get into something that's requiring a $15,000, $20,000 per door renovation, something just a few $1,000s per unit that we can make a quick turn on and capture an upside on that.
Cody, you mentioned broker relationships. Is it one broker? Is it many? Is it 2 or 3 that feed you most of your deals?
Yeah, it's many. We have a long list of broker relations across our markets, and we try to engage with each of them. I spend probably more time with those who are capturing most of the market share in our markets. So there's several that we probably engage more often than with the other ones. But yeah, I think you got to be careful with isolating yourself just to one or a small list of brokers, right? So we probably 40 brokers in between our 2 markets.
And when you sell a property, do you just spread the wealth amongst these brokers?
Well, I haven't been in a circumstance where we've gone full cycle yet, but there is a kind of industry courtesy that's expected where most often you see when a seller sells an asset to you and you complete that transaction, when you're ready to bring the deal to market and go full cycle, it's a common courtesy that you go back to that same broker, unless barring a negative conflict, but we would expect to extend that same courtesy.
That's a good point. How do you get in front of your competition with these brokers?
Now, this is a great question, and it's increasingly harder to stay competitive in this market cycle. Even guys that are much more experienced than we are, that have much larger portfolios, are having challenges in today's marketplace. And so everything right now is coming down to price and risk capital. Ultimately, those are the 2 biggest drivers in today's marketplace. I don't think there's really anything that's market rate that's at a discount anymore. We get price guidance, and that's kind of your starting point now. That's no longer your target. So you have to find ways to be creative and find ways to add value when you're acquiring properties. But you have to go in knowing that you're going to pay full market rate, and you're going to have to be putting up some sizable risk capital to give the sellers that confidence that you're fully bought in and you're going to make this transaction happen. And then also looking at ways to increase your due diligence periods, right? Your inspection periods, right? Looking at shorter timelines. The faster a seller can get to close, the higher chance that you have of getting the deal awarded. So I think between those 3 factors, that's the most effective way to be competitive right now.
And is there any soft sells? So if you think back to like pharmaceutical or medical sales reps, they're whining and dining the docs a lot. Do you guys do that with brokers?
I was just speaking on this with another podcast. And to me, I think that I don't really find that to be very effective on the initial engagement. I think after you've transacted with a broker and you've kind of built that relationship and that trust of knowing that, hey, you can take a deal to close, then that's an opportunity to make it more personal. But ultimately, these are very busy professionals. And let's face it, there's 1,000 new syndicators every single day that are calling all the same brokers. So their time is becoming more and more limited, which means that it's becoming more and more valuable. So they're going to spend it where it's most efficient, which is going to be on guys who are closing deals. So our focus is, hey, let's close deals first and let's build a relationship that way. And then I'd be happy to take you to dinner and stuff after that. But I don't want to waste the broker's time. I want to build that relationship by closing deals and getting transactions done.
Good point. Cody, 850 units. How many properties is that across?
That's across 4 properties.
And what markets are you in?
So again, our primary acquisition pipeline is Houston, San Antonio, Central Texas, but our portfolio as a whole, we have 3 assets here in Texas and then 1 in Columbus, Ohio that we co-sponsor.
Why Columbus?
The relationship with the lead sponsor, great lead sponsor, Chris Jackson and Sharpline Equity. I'll name drop for him. Great guys. We just wanted a way to build that relationship with them and work with those guys. And they're present in that market. They have assets in that market. So we trusted not only their experience, but their presence in that area. And then once we looked at Columbus, we saw that they had really good fundamentals. So it gave us a lot of confidence to participate on that. But it's just like anything else. It comes down to relationships and experience.
We'll get back to the show, but first, some sponsors I'm confident you'll find value in learning more about. When it comes to scaling your real estate business, is lack of capital holding you back? Raising private capital on demand can be a major challenge, but you can get the knowledge and tools you need to succeed when you attend Dana Cornell's 4-week Raise Capital Masterclass Live. After starting out with no capital or relationships, Dana has raised over $1 billion twice in the past 20 years, and he has made it his mission to share the best of what he's learned with business owners and investors like you. You can learn more at danacornell.com/best ever. Dana's Raise Capital Masterclass Live allows you to immediately unlock and raise capital on demand, drastically increasing your business's growth. If you're ready to take your business to the next level, go to danacornell.com/best ever to enroll today. I'd like to introduce you to my good friends over at passiveinvesting.com, a private equity real estate firm based out of the Carolinas. Passiveinvesting.com makes it easy for you to start investing in real estate. They focus on acquiring institutional quality apartments and self-storage facilities with private accredited investor funds. They also have a real estate debt fund that offers hard money loans to local fix and flippers across the U.S., which currently has a 0% default rate. With a portfolio of over $700 million in assets and controlling over $250 million in equity, they know how to secure the best deals and how to avoid the red flags. If you are interested in learning more, please reach out directly to passiveinvesting.com and request the free Passive Investor Guide that outlines the 7 red flags for passive apartment and self-storage investing. Visit passiveinvesting.com/red flags to download that PDF now. That's passiveinvesting.com/red flags.
What value did you bring to the table?
Our primary value proposition was being able to raise capital. We'd spent about a year and a half building a framework and an infrastructure for our business, building out our database through our marketing funnels. So that way we could position ourselves to go and syndicate and raise capital. Ideally, that was going to be for our own deals. But again, with the aggression in the marketplace and not having quite the track record as some of our competitors, we knew that we had to leverage the experience of other operators to really break in. So that's how we started. We started co-sponsoring with other operators that had much more experience. And we added that value through raising equity. And we also love to participate in the asset management side as well, to be involved in some of the decision-making and give input where it's needed and help direct the business plan.
Cody, can you talk about the differences of multifamily in Columbus, Ohio, typical Midwestern city, versus Texas?
Demographic. Obviously, the demographic there is a little bit different than it is here, whether that be lower income, working class versus similar demographic here. Just Houston primarily, where we're based out of, it's primarily a low income working class demographic. But on this core plus product, we're typically focusing on more of your white collar, young working professionals. And I think that's the biggest thing is just working demographics. Both states have very similar laws and legislation around business owners that support business owners. And so we definitely like that aspect. We want to be in business friendly states for sure. But I would say the demographic is probably the biggest differences between the two.
And rent growth, appreciation, cap rates.
So cap rates are a little bit looser there. We're seeing cap rates at about, call it maybe 5, mid 5 cap rate versus Texas here. Everything's kind of a sub 4 cap right now, which is kind of crazy to talk about. 2 years ago, we'd be gawking at that, but now that's our standard. But it is more of a cash flow market. You're going to be able to find a little bit better yield in a market like Columbus versus here in Texas. Again, it's very, very hyper competitive. So pricing is aggressive. So it's kind of harder to find those yields here in Texas. But Columbus, if you look at it from a fundamental perspective, it's kind of one of those kind of steady Eddie markets. It's not like robust growth. You're not having this massive net in migratory patterns like you're seeing here in Texas. But it's a great community for acquiring assets, operating efficiently, providing a good quality resident experience, and then just holding them for 5-7 years for cash flow.
Cody, you mentioned you spent the better part of a year setting up your business before you started acquiring properties. One of the things you mentioned was your marketing funnels. Can you give us an example of some of those?
Yeah, we built out a robust marketing funnel, and we started out with different thought leadership platforms, very similar to what we're doing now, right? Our podcast, our meetup, and really I give a lot of credit to Joe because I read his book, The Best Ever Real Estate Advice book, and he laid that out in his book, right, is you got to go out there and build your network. And you do that through thought leadership platforms. So we started that. We started a meetup, started the podcast. And as we started to build our network, then we started putting things like our newsletter in place, our email marketing, and then really leverage social media. And this is a big one. Social media is the way that the world's connected today. So if you're not visible on social media, then you're really missing out on a prime opportunity to grow your database. And so we leveraged social media in addition to our thought leadership platforms. And then especially through COVID, when everybody was secluded to their homes and not really getting out and doing face-to-face networking, I think we 4X'd our database that year just because of all the virtual networking we were able to do and the outreach that we had from all those different funnels. So thought leadership platforms, social media, and our email marketing were the biggest funnels for us.
You know, I just Googled that not too long ago. So best ever listeners, if you Google Joe Fairless thought leadership platform, he breaks down, I think it's a top 10 list, things that you can be doing to increase the size of your network. Awesome. Is there a particular niche that you're looking for in terms of size of units, purchase price, cap rate?
So for us, we particularly look at value over count. We'd like to be above 100 units just from an operational efficiency perspective. As you go bigger, things get easier to operate. You can have larger teams. Your property management teams can have more staff to operate your business plan. So we like to be typically above 100 units, but for us, we focus on value. And this is really from the debt side. Anything over 20 million, kind of same thing. The debt gets a little bit easier. Terms get to be a little bit more flexible, especially with the transactional volume of last year. The bridge, everything was executed on bridge. So all the debt funds and bridge lenders really kind of exhausted their debt funds. So anything below 20 million, terms were a little bit more rigid. They were going to make you pay heavier spreads on some of those terms. So we like to really be above that $20 million threshold. So for us, our buy box is, call it 30 to 50 million, 100 to 250 units, I would say, and really focusing on that 1990s vintage or newer.
Cody, what's your return to investors?
It's going to be very deal specific for us. What we're seeing in the marketplace right now, especially in our markets in this core plus product, we're looking at a 4 to 6% cash on cash, call it 12, 13% IRR higher. And then we always look to achieve a 1.7x multiple. And we're typically modeling all of our business plans on a 5-year hold.
How do you sway investors to your deals when the returns are fairly similar amongst a lot of multifamily syndicators? What separates you guys?
Well, it comes down to trust and relationship. You're right. There's plenty of other operators out there that are probably equally or much more qualified than we are. But being able to leverage our relationships with investors, we find people that are attracted to us for whatever reason. We like to think we're good guys. We're authentic. We're transparent, and we're relatable. We're everyday people, just like you and me, Ash. And I think that's something that people can relate to. But aside from that, it's just, again, offering something of value, offering people opportunities to get in this direct private real estate, like commercial real estate, and grow their portfolios in a way that suits their thesis. But I think it just comes down to, again, focusing on the relationship, finding that alignment of interest, being authentic is key. And it's worked out very well for us.
How often do you communicate with people in your database that are not investors?
So we send out monthly newsletters. That's our primary way of communicating. Then we have weekly, what we call drip mail campaigning that goes out. And that's to share our different content that we're curating or things that we find valuable that we can share to our database. And even though somebody's not actively invested with us or maybe not in our database, our direct contact list, so to speak, we still try to engage with people. And we look for opportunities to add value to other people. Hey, you may not want to invest with me, and that's completely fine, but maybe we know somebody that might be better suited for you. Or maybe we can make a referral to a connection or a professional that may help you grow your business. So we try to have as many of those touch points as we can. We're talking to potential investors or partners on a weekly basis. Brian is our second partner, third partner, and he's our investor relations director. And between his schedule and mine, we're connecting with 10 to 15 people a week on average, and just looking ways to add value. It can't just be about us, right? We're not trying to be selfish and how do we get value? It's about how do we give value back to others as well.
Cody, what is your best real estate investing advice ever?
Ooh, that's a good question. I would definitely say take action. I think right now is still a phenomenal time to be in commercial real estate. It is hyper competitive, but you can't let that deter you or can't let that put you in a state of fear. Put yourself out there, take action, and go find opportunity.
Cody, are you ready for the best ever lightning round?
Let's go.
Let's do it. Cody, what's the best ever book you recently read?
Ooh, Think and Grow Rich. I read that book many years ago. I've been reading it again. Success is a Mindset. So I really love just revisiting that book and its core principles. So highly recommend that one.
Cody, what's the best ever way you like to give back?
So we leverage our platforms to try to give back to our community. So for example, in our live in-person meetup events that we host every month, this past Christmas, we actually hosted a toy drive. So for attendance, everybody, their admission to attendance was donating a toy to a local toy drive, which we ended up donating, I think, over 100 toys to a local charity. So that was really special. So we like to leverage our platforms to try to give back to our communities.
And Cody, how can the best ever listeners reach out to you?
Well, we're not hard to find, man. Like I said, we're all over social media. So you can find us on LinkedIn at Cody Laughlin. If you want to check us out, you can visit our website at www.blueoakinvest.com. If you want to reach out to me directly, feel free to email me at cody@blueoakinvest.com.
Cody, I got to thank you for your time today, sharing your advice. You started in 2010, single families, 2019, got into multifamilies, assembled a great team, and you've got a great niche. Thank you again for sharing your story.
Thank you so much for having me, Ash. I appreciate it.